Welcome to this afternoon's Economic Society of Australia in Conversation series, where we discuss topical economic issues with leading experts. Let me first begin by acknowledging the traditional custodians of country throughout Australia and their connections to land, sea and community. I pay my respects to the elders, past, present and emerging, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. Today, our very special guest speaker is Professor Bill Mitchell. Bill is one of the foremost thinkers on modern monetary theory and holds the chair in economics and is the director of the Centre of Full Employment and Equity at the University of Newcastle. Bill has published widely in refereed academic journals on macroeconomics, labour markets, econometric modelling, and economic development, and has acted as a consultant to the European Commission, the International Labour Organization, and the Asian Development Bank. Now, today's webinar focuses on Bill's policy recommendations and predictions for Australia as we recover from the shock of the pandemic, and explores how modern monetary theory might provide an answer. It is with very great pleasure that I welcome Bill to deliver his comments.
Well, thanks very much, Belinda, and thanks for everybody who I can't see for taking your lunchtime to participate in this discussion. I'm going to talk a bit about MMT. I've got to put my speed skates on because we don't have much time and we've got 25 years of work. But if you were interested in learning more and you're not sure what it is, then we published a textbook. Macmillan published a textbook in 2019, Macroeconomics. There it is, it's still available. My MMT journey started at Melbourne University in late 1970s. And if you think about it, that was a time of emerging high inflation. The second OPEC oil shock was just coming through. And the response to the first shock was quite poor from the federal government. And we had, for the first time, the abandonment of full employment. And I situate myself on the progressive side of thinking. And I wanted, at the time, the mainstream economics approach was, Modigliani and Papademos had published in 75, the Nehru. And, by the time I was starting to get towards my honours year and then into postgraduate, we were getting these ridiculous estimations coming from econometric models that the Nehru was suddenly 8 or 9% in Australia. And of course, the policy prescription was you couldn't do anything about that on a macro basis. And I didn't believe any of that. And as a young econometrician, I could squeeze any elasticity out of any set of data, and so I knew, and the confident intervals, the standard errors on those estimates that were being used by people were, the Nehru could be anything from 3% to 14% or something. So I knew that it wasn't a very good measure for policy, and so I thought about developing new ways of thinking that would allow the government to fight the inflation that was a problem without causing the unemployment. And so that's where I started. And then, and at that point, I developed what I called a buffer stock employment model, and which we now call a job guarantee, which uses a buffer stock methods to get price stability. And an employment buffer stock, of course, if you read my work, you'll see that I think that it basically flattens the Phillips curve and gets rid of that trade-off. But then the next major event was Japan, and the largest commercial property collapse in history in '91, and I became very interested in Japan because their unemployment rate hardly ticked up. And I started to correspond with people in the Bank of Japan, started to understand that this was a different way of running macro policy. And had essentially became a laboratory for substantial number of mainstream propositions like do fiscal deficits drive up interest rates? And the answer is no, of course. And so I started, and does central bank buying bonds either directly or indirectly in the secondary markets, does that cause inflation? The answer is no. And I wanted to then start putting theory together to work out an understanding of why that happened. And then I met in 1995, I met Warren Mosler, who was an American banker, Wall Street banker, and he had been developing a lot of similar ways of thinking. And so we started working together. It was quite an extraordinary partnership, me being from the ivory tower and him being just in the daily grind of Wall Street. And together, and then with others, we started to develop MMT. So what is it? Well, the first misconception is it's not a set of policies, and it's not a policy regime that you can go to or leave. The way I like to characterise it, it's a lens, and it's a way of seeing the current monetary system and its institutions and the capacities of the currency issuing government and the consequences of using those capacities much more clearly. That's the lens allows us to see through the fictions that have been created by mainstream economics. And so we reject a number of the main propositions like money multiplier theory, loanable funds theory, which then leads into crowding out types notions. We reject all of that because we examine from the ground up the institutions and the way the institutions actually work, not the way we theorise them to work. And a lot of the insights that I gained from studying and communicating with the Bank of Japan has allowed me to understand very clearly the impact of, say, fiscal deficits on the cash system, the reserve system, the commercial bank reserves, the way in which that creates challenges for the central bank, the way in which the central bank can manage liquidity, and a whole raft of other important things to do with the way the monetary system operates on a daily basis, which then leads you to reject all of those core propositions that are taught in universities by mainstream economists. And so when I say it's not a policy regime, the point is that understanding that we created, that MMT creates, to operationalise that into policy, you need an ideology. So a person with more progressive ideology who thinks in terms of more of collectives and society, who thinks in terms of more public type solutions, can have exactly the same understanding of the way the monetary system operates, an MMT understanding, as a person who thinks more on the right or the individualistic way, whatever way you want to conceive of that. And though we'll share the same understanding and the same understanding of the consequences of doing things, but have totally different ideologies and therefore different policies. So I'll emphasise, for example, public education, public health, public employment, so those type public transport solutions like that. And the other person will not emphasise those things. They'll have different, more private market type solutions. But it's really important to understand. And so many people fall into the trap of saying, oh, those MMT policies. Well, there are virtually no MMT policies. There's an understanding. Now, another major event where the modern bit comes from was August 1971, when President Nixon suspended the gold window. And that ended the Bretton Woods system. Well, it didn't end it. It staggered on for a couple more years until the Jamaica Accords ended it officially in 1975. In the period in between 71 and 75 was the, failed attempt through the Smithsonian agreements. But the end of the fixed exchange rate system changed the constraints on government policy. In the fixed exchange rate system, the central bank had to prioritise maintaining exchange rate within the agreement, within the agreed parities. Fiscal policy had to play a subjugated role, because we had these stop-go type growth scenarios where the government would be politically unpopular, try to stimulate the economy, that would drive up imports, and that would cause downward pressure on the exchange rate. And the monetary policy had to then tighten with the foreign exchange interventions plus interest rates to attract capital through the capital account, and fiscal policy had to tighten again. And so in effect, the government was always having to manage liquidity very closely. And so any of the liquidity effects of, say, government spending into the cash system had to be offset through taxation and bond issuance. And so the government was constrained in those ways. After the fixed exchange rate collapsed, of course, the central monetary policy was freed from having to defend the currency, and fiscal policy was freed also to pursue domestic objectives without being compromised by what the central bank was doing in the foreign exchange market. And as a consequence, the government then eliminated its financial constraints. So a currency issuing government in a fiat currency system, which we entered, countries entered that at different times, because Australia took until the mid-80s to float, whereas America floated immediately in 71. And under a fiat currency system, the government has no financial constraints. So all of this talk about how we're going to pay for things and where's the money going to come from, that's then politically weaponised to maintain elevated levels of unemployment and not do things in the health system, or not invest enough in climate transition and all the things that we talk about now. Those questions are fictional. They're political. They're not based upon any inherent capacity that the government has in the monetary system. And that's what MMT brings out. It shifts the focus. So the federal government in Australia can buy whatever's for sale at any point in time in Australian dollars. It has no financial limits in what it can do. Now, that's not the same thing as saying it's not constrained. I'll come to that next. But it has no financial limits. And all of this hoopla we go through about the debt and the size of the deficit, they're all just fictions. Is a 2% deficit better than a 4% deficit, or worse than a 4% surplus, whatever, of GDP? Well, we can't answer that question because we don't have a context. And the context is what fiscal policy is doing and what the non-government sector is doing with respect to spending and savings. So if you've got an external deficit, for example, which Australia's had until very recently for four decades or more, averaging about 3% of GDP, and we'll return to that once the terms of trade reverse again. Well, if you've got an external deficit draining out net spending from the external sector, and the private domestic sector, households and firms, want to save overall, well, then you have to run a fiscal deficit, or you will cause recession. That's the context. And if you try to run fiscal surpluses in that context, you will cause recession. And the only reason, for example, Peter Costello was able to run 10 out of 11 years of surpluses was because of the massive increase in domestic private debt that maintained consumption expenditure and offset the fiscal drag coming from the from the fiscal policy. And if households hadn't have gone from what, 60% of disposable income debt to what, nearly 200%, Australia would have been in recession by about 98 with Costello's policies. And later the terms of trade effects helped him as well. But to say that a 2% deficit is worse than a 4% surplus is just a meaningless statement, because we need the context. We need to know what the other sectors are doing. And when you think about it, fiscal policy is not, the design of fiscal policy isn't to achieve any particular financial ratio. It's to achieve well-being. It's to achieve the things. The government's our agent. And so we want our agent to use its currency capacity to do things that advance our well-being, like full employment, like good public health, good transport systems. And that's the way we should judge fiscal policy. And so what MMT does is shifts the focus from financial constraints to real resource constraints. And government spending is constrained by the real resources that are available, not by where it can get the cash from, because it gets the cash by typing numbers into bank accounts. Boom, 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 and that's the government spending. Doesn't get it from tax revenue. It doesn't get it from issuing debt. The national debt is just our wealth that's past deficits that haven't been taxed away yet. That's all national debt is. And when Costello was running those surpluses and going on TV and crowing about how wonderful it was getting the debt monkey off the Australian people's back, what he was effectively doing was squeezing the non-government sector, us, and destroying a segment of our wealth, which was held in the form of government bonds. The fiscal squeeze forced us to liquidate. And so MMT provides all of those different understandings of the situation. So I know that's inadequate, but that's the time constraint I've got. I know that there's an institutional structure that makes it look as though the government spends tax revenue, but intrinsically it doesn't. It doesn't have to. It spends by just typing numbers in, and then has accounting ruses to make it look as though that's where they get the money from. And, you know, the government the new Prime Minister could announce today that before the government spends tomorrow, I'm going to do 50 push-ups. And that'd become we'd say, oh God, he's constrained by how many push-ups he can do. Well, that's what all of those accounting conventions that the Department of Finance and the central bank, that's what they comprise. They're just screens to cover up the intrinsic nature of what's going on. So I could talk more about the theory and whatever, but I know that we've got to talk a bit about the current situation. Now, I'm on the public record as saying that I believe this inflationary period is transitory. And what I mean by that is not that it may be short-term. Transitory doesn't have a temporal element to it. It just means that the normal propagating mechanisms that might make it more persistent are not there. Now, what do I mean by that? Well, what's causing the inflation? Well, of course, the pandemic initially caused it. So you had, for example, huge sectoral imbalances emerging between demand and supply. How? Well, the service sector collapsed because all of us were locked down and too scared to go and get our hair cut. And in lockdown, we satiated our frustration by going on into the goods market and buying all this stuff online and renovating our houses and doing gardening and buying stuff at Bunnings online and whatever. And so you had this, and meanwhile, the goods market was facing major supply constraints because of workers getting sick in factories, ships not being able to deliver stuff, truck drivers not being able to deliver stuff, and all of those supply disruptions that are still ongoing, and caused a massive collapse in the supply of goods in terms of timely supply. And so you had the pressure of that shift in demand of goods away from services, at the same time that you had the supply problems in the goods sector. Now, you're always going to get price pressures arising in those circumstances. And then on top of that, we had OPEC flexing its muscles with some weird profit maximising scheme that they use to suppress supply. There's excess supply capacity in OPEC, but they refuse to use it because they are making massive profits. And on top of that, so that's a cartel. It's got nothing to do with the size of deficits or what central banks have been doing. And on top of that, then we have Russia invading Ukraine, causing huge disruptions. So all of those things, they might be enduring, but they're temporary, and they will eventually be terminated. And already, if you look at last night's PMI from the Euroflash POI from the PMI from the Eurozone, you see that for the second consecutive month, cost pressures in the Eurozone have been falling, and suggesting maybe that's peaked already, but I'm not as confident as that. But that's what you're seeing in the data last night. I saw that release last night. And what I mean by the absence of propagating mechanisms is that the long-term expectation indexes all around the world aren't really kicking up very much at all. And there's definitely no wages pressure. Now, someone pointed out, I saw yesterday that the German negotiated wage index was pushing up, but that, if you go in to examine that more carefully, you'll see that that was just a once-off catch-up measure that the government had promised. That'll go out of the system, and you'll get wages pressure back to about 2%, which is no pressure at all. So they're the propagating mechanisms that caused the 70s inflation to go right through to the 91 recession. We don't have them at the moment. And so in my view, inflation remains a transitory phenomenon. Doesn't mean it's short term, but it will exhaust very quickly if those propagating mechanisms don't start to play a role in their own right. Now, what does that mean then? That means that the central bank is mad increasing interest rates. And it was an act of vandalism, in my view, for the Reserve Bank to increase interest rates and promise more. Because how will increased interest rates get trucks to deliver goods more quickly, get ships running where they should be, get workers not to go back to work who are not sick anymore, get the Chinese government to end its lockdowns? Interest rates are not going to do anything to ease the supply pressures. And what all they're going to do is cause further grief to low-income workers and those low-income families that were induced by Reserve Bank statements in 2020 and 2021 that they were going to wait until wage pressures emerged before they moved on rates, and that they were holding out that there wouldn't be any rate movements for at least until 2023, probably 2024. And as a consequence, people borrowed beyond their capacities because of the way the banks push credit onto anyone who moves. And as a consequence, you've now got this situation where the Reserve Bank has basically reneged on that promise or that holding out, and they're punishing the people they induced to buy properties. And and all they'll do is cause damage. They won't solve the inflationary problem. And if the pandemic eases and the shipping system gets back to closer to where it used to be, then those inflationary pressures will disappear very quickly. And I think, as I said, in Europe, you're seeing those cost pressures falling quite quickly. And so in that context, the major challenges are really not inflation, in my view. The major challenges are the housing sector. So we're at least 450,000 houses short as a consequence of years of neglect from state and federal governments on social housing. And that has to be addressed if we wanted to address housing affordability and reduce the inequality. And that means we also have to increase supply, but it also means we have to reduce demand from those that have already got 20 houses. And what I mean by that is that I think the government, if it's looking to save some tax foregone, they should have ended negative gearing years ago. And negative gearing doesn't reduce rents. It doesn't do anything other than transfer wealth into the hands of those that have already got sufficient wealth. So there needs to be action on housing. There definitely needs to be action on job creation and job quality. There definitely needs to be action on restoring some of the integrity of higher education, my sector, and certainly ending this private competitive vocational ed farce that has delivered nothing by way of productivity gains, has lined the pockets of capricious private sector educationalists and gutted TAFE as the primary vocational education provider. And the big challenge in the future, as the Australian population ages, is productivity. It's not whether we'll run out of money to afford everyone to have hip replacements. We need to, because the dependency ratio is rising, we need to make sure that the new generation of workers is much more productive than the last. And that comes from research and development. It comes from education and training. And those things have been really run down and neglected by this obsession with fiscal surpluses, and that has to change. And of course, our health systems have been really stressed, and all of the cuts and the amalgamations, particularly say in Victoria, Victoria in the last 2 years paid for the Kennett destruction of the health system, and they've got a big catch-up job to do, and that needs massive investments. And of course, climate change. We're going to need a massive transformation of our consumption and production habits. We're going to, and the market isn't going to deliver that. The market's doing some of that, which is fantastic, and it's fast-tracking renewables, but we still need a lot of government activity there in creating transition frameworks so that we can induce and take care of coal communities like up in the Upper Hunter, just up the road from where I am today, and so that those communities don't feel as though we're attacking them, but we're providing them with pathways to maintain prosperity, material prosperity, while contributing to the climate effort. Now, if you put all those things together, and I could go on with more, but those things are going to require substantial government investments, and any talk of going back, of chasing fiscal surpluses now will completely undermine our ability to meet those challenges. So in closing, I've had to really go fast, but in closing, inflation's transitory. It doesn't mean it's not a problem, and it doesn't mean we should be looking after low wage workers to make sure that they don't fall too far behind. but that shouldn't be the obsession of governments. There's too much investment to be done in the next 5 years to make sure we become a high productivity, carbon neutral nation with high training and educational standards, improving our public health system, and setting us up for the ageing society future. So I'll leave it there. Thank you very much.
Thank you so much, Professor Mitchell. So I will now open it up to questions, and I will select the most popular ones to start with, but do keep upvoting questions that you like to have answered. And we do have quite a few to get through, so hopefully we can tease out some of those additional points that you wanted to make, Bill. So firstly, regarding, we have a question from Todd McHenry on the transition to net zero. So I guess what role should the government play in transforming the economy to a circular economy? Just to fill out that question a bit more, the government is a vehicle for progressive change. It must play a key role in empowering hard to abate industries to begin that transition to a more sustainable way of life. So what are your thoughts on these types of technologies, such as carbon capture and utilisation, being better funded by the state to give these industries a bit of a nudge? And is there a better pathway?
Yeah, good. That's one of the key questions that are facing us all, really, in academic life, in research and in public policy. And I go back to the mid-90s, where the concept of just transition came about. And a Canadian trade unionist who developed that concept was working on a dispute in the chemical industry. And it was quite clear that for this particular sector that there'd be massive job losses if the government imposed hard, environmentally sensible restrictions on the development of further infrastructure for that sector. And that trade unionist was very enlightened and said that as long as the government avoids the questions of jobs, the workers in those industries are going to side with the bosses in those industries and continue to advocate for investment in those pollutive technologies. And so the lesson that, and this is a problem that I think the environmental lobby in Australia and elsewhere have had for decades. They, think back to the Adani problems before the last federal election. You get urban environmentalists going into regional areas like the Hunter or up to Gladstone, up into that area, and all of these areas, forestry areas, coal areas, and just preaching that you've got to shut down, but giving no pathway or hope for those communities. And I've been urging those groups for years to put jobs at the forefront of their advocacy, because unless you offer people in Singleton, in New South Wales where the coal is, unless you offer them job pathways to make sure they can keep paying their mortgages, make sure their kids can stay at school, and make sure they've got decent material lives, then you're never going to get the political support. And I think that all of us, unless I'm not including the manic fringe here, but the vast majority of Australians would be environmentalists, would be green. We are seeing the problems of climate change and we want to do something about it. And so we're willing to jump up to the plate and do stuff and support government policy. And I think the most recent federal election has demonstrated that quite clearly. But unless we have a government that's willing to set up transition frameworks with jobs at the forefront, then we're not going to make much progress, and those areas will bunker down and oppose these policies in the political way. And so, you know, government has the capacity to invest substantially to make those transitions occur. So I've been advocating for years in the Hunter, which is facing an existential crisis with the necessity to eliminate the coal export industry as soon as possible. It could become the renewable energy hub of Australia and create vertically integrated industry structures where you have research and development, manufacturing, technical assistance, sales, design, and all of those aspects that will go into Australia becoming a renewable energy power. That has to have investment, and at the moment it's not going to come from the private sector. And as a consequence, I believe it has to be a key role that the government plays. And in addition, the government has to, I don't support using the market to make this transition as fast as we need, because we've got instances all around the world where carbon emission schemes are corrupted. And I think these carbon offset schemes just really allow the first world polluter to continue while going into places in India and less developed countries and, you know, walking roughshod over local culture and local traditions and creating some infrastructure that they can claim offsets. So I don't think that's in our interests as a globe to do that. I think we need regulative structures and a rules-based transition where the coal industry is given a period, not informed by me, but by experts in this area, to close down, and that's the end of it. And as that period is unfolding, transition mechanisms for workers and small businesses who've got capital at stake so that they don't get stranded assets, and all the rest of it needs to be done. And the market's not going to do that. And as urban people who want that to happen in our regional areas, we should all be supporting that.
Wonderful. Thanks so much for that, Bill. Next question, I'm going to actually roll a couple of these questions up into one. They all kind of talk about the politics of MMT. And I guess really, do you think there is a good understanding of MMT among sort of the politicians? And why do you think we have this situation where these things that do seem fairly obvious, that MMT obviously has some constraints, it doesn't seem to be getting through in the mainstream sort of thinking. So kind of wrapping up those questions, do you think there's a really good understanding, and perhaps why not, of MMT in the mainstream sort of thinking?
Yeah, I mean, this is a great question. And I did see a sort of corollary of that from Ferrier Sylvia about MMT and progressive politics. And that's why I said that it's about ideology policy. MMT is essentially politics neutral. Now, you might get the impression because I'm on the progressive side of politics as a person, and in my ideology about, you know, collective solutions and public solutions and caring for people, and the state is responsible, in my view, for making sure everybody is progressing in life and has opportunities. Doesn't mean equalising outcomes, but equalising opportunities. You might, and because I'm one of the founders of MMT, you might say, oh, well, MMT is progressive. Well, no, it's not. You could be an extreme free market right-wing zealot like I'm a progressive zealot. And you still would have this, and you could still share the understanding of the system with me, but you would just understand that there'd be different consequences. And so MMT isn't isn't anything to do with progressive politics. MMT is my academic work, and the way I apply it to policy questions and policy discussions is because of my ideology. But I know I can point you to MMT people who are on the right who have totally different policy sets to what I have. Now, the more substantive issue that you want to explore is about paradigm shift, I think. And for those who have studied philosophy of science, you will know that paradigms in academic disciplines change very slowly. And if you've read the work of Imre Lakatos in the early 70s, you'll know that he talks about degenerative paradigms, which start to lose empirical veracity. In other words, they stop being useful to explain anything about our world in terms of the data and what's happening, yet they hang on to their superior position in the academy and therefore in policy-making circles, etc., because of the way in which these academies work. And, you know, Max Planck, the physicist, is summarised as saying that paradigms shift one funeral at a time. And what he meant by that was that you've got all these senior professors who've built their reputation on their work, and then some young buck comes along and demonstrates in their PhD, for example, that their work is fiction, and that's an existential challenge to the core senior professors who resist it. And paradigms resist change all the time, and they enter a stage which we call groupthink, where they deny reality, and eventually the dissonance of what's going on relative to the perceived dominant paradigm becomes so great that eventually the paradigm shifts. Now, you know, the classic example is the idea that we have our brains can heal themselves. So in the early 60s, the conventional wisdom was that once you had a brain injury, it wouldn't heal. And all of the clinical practice was predicated on that. And all the senior professors had made their reputations on that basis. And then a young PhD student in 1962 came up with the idea that brains do heal themselves. Somewhat. They stitch together electric circuits and fix themselves up a bit. Now that young student was vilified by the senior professors and driven out of the profession, more or less, and diverted into other research projects. And then the dissonance, of course, through the 60s and the 70s and the 80s, that people started to look as though their brains were healing after serious car accidents, for example. And then in 1995, and over that period, some of the senior professors had retired and died. And then in 1995, another young student came out, a woman in this case, came out with the same research proving that brains heal themselves to some extent. And the paradigm shifted at that point. The dissonance became so great. And the economics paradigm is is the same. We've got such a vested interest in all of the things that I call fictions, that it's going to take time and all the dissonance that's occurring before the paradigm shifts. Now, you know, the fact that Macmillan, the largest textbook publisher in the world, gave us a contract to publish our work and is renewing that contract tells you that the paradigm's shifting. The fact that we're now in a fiscal dominant era where monetary policy is subjugated tells you that the paradigm's shifting. And I'm quite happy for mainstream economists to say they knew it all along. That's fine by me. They didn't, but I'm quite happy for them to use that as a way of smoothing the path in their careers away from their previous held views to more modern views, which are more empirically sustainable. And the last thing I'd say on that is that Australia is very resistant to changing, the policy makers and the academy. But I've got great relationships in Japan. And so it's quite clear to me that some sections of the senior policy bureaucracy in the world have made the change already. And you can see that in the way the Bank of Japan operates and the way the cabinet operates. Very different to the way they speak very differently about policy than the way we do.
Lovely. Thank you so much, Bill. I think I might move on now to productivity. And we might, depending on time, we might wrap it up with this really great productivity question, because it is really at the forefront of policymakers' minds, thinking about business dynamism and whatnot. But what obviously we know we have to raise productivity. So what policies would you recommend to maximize productivity growth? And can you explain perhaps how a job guarantee would be perhaps less inflationary and cause fewer labour supply bottlenecks than the current Nehru approach?
Well, they're two separate questions, of course, but the productivity one's the really big issue facing, it has been the big issue facing Australia for years. Now, the first point I'd make about productivity is that the way we construct the idea is extremely biased. And it goes back to the 1930s, more or less, the gainful worker concept that emerged as labour force frameworks were being devised. And we had this idea that a gainful worker was someone who worked for private enterprise to create profit. And anybody who didn't do that wasn't gainfully employed, as the expression in the literature emerged. And so we had this idea that productivity has got something exclusively to do with private sector, the private sector and augmenting private sector profits. Now, it's got something to do with that for sure. We want all inputs to be to create the best quality and quantity of output. So we don't want waste. We want to eliminate waste wherever it might be. That's true. But we should also understand that productivity goes much broader than just a worker working for private enterprise. And it's massively, and I think during the pandemic, we saw the benefits of low-wage workers, the cleaners and the nurses and the people that really saved our lives in many ways. And so I see productivity as a social concept. And you think about that and you say, well, what's a problem in Australia? I'll give you an example of why I think like that. What's a problem in Australia? Well, this summer just gone, we've had a lot of deaths from drowning on our beaches. And so who knows, and I'm a surfer, so who knows the beaches and the dangers and the water very well? The surfers definitely do. And so why not? And the surfers also, because of their lifestyle, not my lifestyle, but the typical surfer, their lifestyles may predicate them to not being employed on a systematic basis because they like surfing more. So why not offer them a job, public sector job at a minimum wage, where what would they do? They'd go surfing. But what else would they be required to do? Well, they would be required to take classes for school children, teaching them water safety. Now, would that be productive? Highly productive. It would reduce drownings. It would reduce all the trauma and lost income arising from drownings, the lost output arising from drownings. Highly productive. That's a social concept of productivity. Now, as I said in the main talk, the challenge facing Australia in part is the ageing society. We're all getting older, and that changes the dimensions of what policy needs to aspire to. There's going to be more demands on our health system and less on our kindergartens. And we've typically constructed the ageing society with all of these intergenerational reports that keep coming out with nonsensical projections. We've constructed it as a financial problem. And so, the government's sequence of them, not just Liberal, but also Labor previously, they did produce the intergenerational report and say, oh, we've got to get surpluses and save up for the future. And saving up for the future meant cutting spending in education, cutting Australian Research Council budgets, cutting vocational education and those things, and creating unemployment or extending unemployment, and to get these surpluses. But in doing that, they are really undermining the solution, because the solution to the ageing society is to expand productivity. And you only get productivity through research, through invention, through innovation, through better work practices, and that and better training, higher skilled workers, better understandings between workers and bosses, higher real wages to induce people to work more productively, not through encouraging the gig economy, but encouraging high skilled labour. And all of that requires substantial investment. And that's one of the huge challenges for this new government, that if they revert back to we need to get a surplus and start looking for savings in education and training and research and development and those things, then they'll undermine the future, and we'll find out 10 years down the track that we've really let ourselves down.
Wonderful. Thank you so much, Bill. I think that's a really great place in which to end. Thank you so much, Bill, for refreshing our understanding of debt and deficits and how they can feature in the recovery from the pandemic. Thank you also to our members for your participation this afternoon, and really have a great week ahead.
Thanks very much. Thanks for all your help in organising this.